Hey guys, what's up? I'm Erin and welcome back to the channel. Scrolling through my newsfeed recently, a headline caught my eye. I'm a bank teller. 7 reasons you shouldn't keep more than $3,000 in a checking account. Initially, I dismissed this article as clickbait, which it is, but it kept appearing on my feed. And this made me wonder, okay, what kind of argument are they making? And if it keeps showing up, does this mean that a lot of people are clicking on it and getting bad information? So I finally clicked and here we are, so let's dive in. I'm going to group 2 of the points made in this article together because they're essentially the same thing. The first point being no interest is earned on large balances, and there's no opportunity for compounding. These points are true as checking accounts notoriously have very low interest rates. For instance, the national average interest rate for a checking account is approximately 0.07%. This means that a $10,000 balance would yield only $7 over the course of an entire year, and that is hardly making your money work for you. The money kept in your checking account is meant to be your working capital. This is the money that is used to cover your daily expenses. Maybe that's a mortgage or transportation, clothing, you name it. If you want to put your money to work and grow it long term, well, that's money that you want to invest in, say, index funds or the stock market. The article also suggests that when funds are easier to access, this can lead to increased spending. And this notion does hold merit. If you are someone who has the propensity to spend, maybe having a larger account balance could give you the green light for more impulse purchases. And behavioral economics does have a way in here. They tend to say that when funds are very easy to access, and especially when we use cashless paying methods like a debit card or a credit card, people do tend to spend more. To mitigate this, the funds well in excess of your immediate expenses should be separated out into different accounts. Establishing an emergency fund is essential. Typically, you want this to cover, say, 3 to 6 months worth of living expenses. And storing this fund in, say, a high-yield savings account or a CD or a money market fund not only restricts the impulsive access, but also allows your money to earn substantially more in terms of interest or returns. These accounts offer substantially higher interest rates, especially when we compare it to checking accounts, so this allows your money to grow more over time. So money meant for short-term savings should be still getting the highest yield possible. Money meant for long-term investments, well, that should be invested so it maximizes its growth potential. Ideally, you just want to strategically use your money so you're making the most of it. You're putting your money to work for you in the best possible way. Next, the article says you lose out on opening bonuses, saying that if you're utilizing just one checking account and having a substantial balance in it, you're missing out on the opportunity to open new accounts and potentially capture a cash sign-up bonus, maybe $100 or $200. A lot of banks do offer one-time cash bonuses if you open a checking account with them and satisfy the other requirements. And I think that's a great move if this is offered by a financial institution that you like and you want to have an account with. If that's the case, go ahead and go for it. But I absolutely do not think that you should be spending your time opening up a checking account after checking account after a checking account, and then finding yourself with a dozen accounts at a dozen different institutions. You have so many better things to do with your time, and I kind of look at that as nickel and diming your way to wealth. Why make your financial life more complex than it needs to be? Why have more accounts than you actually need? Open the accounts at the institutions you want them at, and then stick with it. Next up, it says your money isn't as safe as you think because the FDIC only insures up to $250,000. Now, this is an important limit to keep in mind because FDIC insurance really does only go up to $250,000 per person per account ownership type. For instance, if I had $250,000 in an individual checking account at an institution and then $250,000 in a jointly held checking account with my spouse, this would allow the total amount of money, $500,000, to be protected under FDIC rules. And that's because there's different account ownership types here. On the other hand, if I had $250,000 in an individual checking account and then $250,000 in an individual savings account, because they're both held solely in my name, this would leave $250,000 vulnerable and not protected under FDIC insurance. So if you have larger sums in these accounts that exceed that $250,000 limit, it can be a really good idea to spread it across multiple institutions or across multiple account ownership types so you ensure that all of your money is protected. While the article does correctly note the importance of the FDIC insurance limits, comparing a $250,000 coverage cap to a $3,000 account balance is not entirely relevant. The FDIC limit is designed to protect substantial deposits. Therefore, concerns about exceeding this limit are more pertinent to individuals or entities with deposits nearing or surpassing $250,000. If your account balance is around $3,000, the FDIC insurance available at the standard institution is more than sufficient to cover your needs. For this author to express concerns about insurance limits for these low account balances is not applicable to this situation. Next, the article mentioned that maintaining a higher checking account balance could negatively impact your ability to get a mortgage or an auto loan or some other approval type. And really, this is just a false statement. Having substantial account balances generally enhances your ability to qualify for a loan. When lenders are determining whether they want to approve your loan, they assess your credit worthiness, and robust account balances are a very positive indicator. This would signal financial stability and financial responsibility. On the other hand, if you do have a bunch of erratic deposits showing up right around the time that you're applying for a loan, that could be a red flag for the institution. But as a whole, if you simply have robust account balances, that's a good thing for getting the loan you want. The very last point mentioned in this article is that a large account balance could make you a target for fraud. And there is a lot of truth to this one. And while no account can be 100% safe, you want to make sure you're taking the necessary precautions. That's using strong passwords, two-factor identifications, and being very wary and cautious of any texts or emails or phone calls that look like they're coming from your financial institution. When in doubt, don't interact with any of those, and you contact your institution directly. When it comes to your money, you want to be as safe as possible because no one will ever care about your money more than you do. And while we're taking a moment to talk about scams, I want to say never interact with a financial advisor who leaves comments in the YouTube section. Those are always 100% scams. If you see someone trying to impersonate me and ask for personal information or asking you to contact me, that is not me. I will never ask for your personal information. And some of these scams are really scary because they're using AI to impersonate my voice. I'll insert a clip here.
Hello, Chris. I'll recommend you get this assets now and secure them, awaiting for what's coming. I'll walk you through the process on how to get and secure them. Let me know when you're ready.
That is not me, and that is incredibly scary. This is an active, currently running scam that is held on Facebook, and I have contacted Facebook so many times in an attempt to get them to shut this down, and every single time they come back to me and say it's not their problem, they don't want to get involved. So to say that I'm a little bit disappointed in Facebook is an understatement, but I just want to say no matter who you are, no matter what your account balance is, be as vigilant and as protective as you possibly can of your money. This article did make some valid points, but ultimately I felt like it was a lot of fluff designed to get clicks. According to the U.S. Federal Reserve, the median account balance, including savings and checking, is $8,000. The median transaction account balance hasn't been below $3,000 since before the 1990s. The author likely knew this and intentionally framed this article in a way to make people feel like they were doing something wrong when it came to managing their money. The real takeaway is that you want to check your accounts on a regular basis and ensure all the transactions that you see accurately reflect your transactions. You want to keep a baseline amount in your checking account plus a little bit of a buffer to make sure that you don't overdraft, but outside of that, you want to make sure your money is being put to work for optimal use. For short-term goals, move the funds to a high-yield savings account, a CD, or a money market fund where it will earn greater interest. For long-term investments, put your money in the market so your money can grow and compound over time. Your checking account balance should fit your lifestyle and your financial needs. There is no universal one right number to have in a checking account. So is it bad to have over $3,000 in a checking account? Absolutely not. Most people do. Ignore the clickbait headlines that are designed to have you second-guessing your financial decisions. And perhaps you're wondering, do experts have a recommended amount that you should have in your checking account? Well, they do. It's 1 to 2 months worth of expenses plus a 30% buffer for those unexpected expenses that tend to pop up. So for instance, if you have $3,000 in routine monthly expenses, this would give you a baseline amount of $3,000 to $6,000 that should be in your checking account at any given time, plus a 30% buffer, which could be anywhere from $900 to $1,800, depending if you want to base that buffer off 1 or 2 months worth of expenses, giving you a floating checking account balance of $3,900 all the way up to $7,800. That way you know when all of your auto pays happen or when your automatic withdrawal and investment into your Roth happens, you're not accidentally going to overdraft your account. It's essential that we tailor financial strategies to individual circumstances. Arbitrary thresholds like a $3,000 checking account balance does not apply universally, and I would argue that this type of advice hurts more people than it actually helps. So when you want to establish how much you should have in your checking account, look at your daily expenses and go from there. Make sure that you're personalizing your financial needs to your situation. What are your thoughts? Would you care to share how you determine what your balance in your checking account is? What kind of methods do you use? Is it based off what your paycheck is? Is it based off what your expenses are? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Can't say us, I don't really spend at all ever. Zero joy in spending, no thank you. If you are someone who has a propensity to spend, I think my eye did something weird, I'm like, okay. Open your eyes. And if we're using cashless, why can't I say cashless? Why blurring my words today? Jeez, oh Pete. They say it's not their problem. So frustrating. So frustrating.